Banks are an important part of the economy. They serve as matchers between savers and borrowers. Recall from the loanable funds market, we learned that for investment to occur, we need people to save. Banks allow matching of supply and demand in the loanable funds market. To keep on operating, firms need to charge for their services. The way the banks make money is to charge borrowers a rate higher than the rate that they pay out to savers. That's sometimes called the margin. These rates tend to go up and down together, keeping a constant margin for the bank. However, there are times when this margin increases and other times when it decreases. Here's an example of the margin since 1990. Banks take the money people save and lend it out to borrowers. Therefore, each bank has assets and liabilities. Their liabilities are the saved money because they are required to make it available whenever a saver, you, come back for your money. Assets are the loans that they give out. The bank also uses some of the money that they make to buy other assets like treasuries or anything that earns them interest. The rest of their funds are held in reserves. These are funds that are not loaned out. Banks are required to hold some money in reserves, but may choose to hold more than required. Those are called excess reserves. The amount of money banks are required to hold as reserves is determined by the Federal Reserve Bank, or central banks. Most countries have what is called a fractional reserve banking system. That means the bank is not required to have all deposits at hand. They're only required to hold a fraction of the deposits and make them available. It is important to detail the fact that keeping money on reserves is a loss of income for the bank. Banks usually would like to lend out as much money as possible so that they can earn as much income as possible. The reason banks keep money in reserves is for two main reasons. First, to minimize the chance of a bank run. A bank run is when many depositors, savers, run to the bank to withdraw their money at the same time. This is more likely to happen when faith in the banking system is questioned or is perceived to be unsustainable. The second reason is because there is a required amount by the Federal Reserve Bank. That requirement is called the required reserve ratio. At the time of the recording, the required reserve ratio is 10%. That means for every $100 in deposits, the bank is only required to have $10 in reserves. It can then lend out $90. Bank can choose to keep excess reserves beyond what is required, so total reserves might be higher than the required by the Federal Reserve. Keeping and maintaining faith in the banking system is important for the economy. Without savers, we won't have investors. Governments have a long-run incentive to keep the banking system healthy and minimize bank runs and bank panics. A bank panic is when several banks experience a bank run. In the United States, this happened during the Great Depression. Between 1929 and 1933, 9,000 banks failed in the United States. The United States introduced the Federal Deposit Insurance Corporation, or also known as FDIC, and their role is to insure deposits. Today, each bank account is insured up to $250,000. FDIC insurance is designed to establish faith in the banking system and reduce fears of losing money in the event of a market collapse. Like with anything, there's critics of this system. Critics of the FDIC insurance argue that it creates moral hazard. Moral hazard is when there is a lack of incentive to protect against risk because you are protected from the consequences. Critics in this case argue that the FDIC creates a situation where banks are taking on more risk than actually is optimal. So now that we established the foundations of banking, let us talk about how banks actually help in the creation of money. Banks do not mint new money, but they can create new deposits. Let us take an example of a hypothetical bank, let's call it H Bank. We'll make several assumptions for this example to work. First, the required reserve ratio is 10%. Second, the bank keeps only required reserves. Finally, all currencies deposited in the bank. That means we aren't hiding any money under our mattresses. Let's say that you take $1,000 that you have earned and deposit it in H Bank. H Bank will have $1,000 liability now and $1,000 in assets. Their assets will be split into required reserves of $100, and they will have $900 to loan out. They loan out the $900 to your friend, and that process is then repeated at your friend's bank. The second bank creates 900 times 90% or $810 in loans. This process repeats itself over and over again, with each bank loaning out 90% of their deposits, till there are no more dollars left to loan out. We can calculate how many new dollars in deposits were created by using what's called the simple money multiplier, which is 1 divided by the required reserve ratio. This example, it's 1 divided by 0.1, which equals 10. That means for every new dollar deposited, banks can create an additional $10 in deposits. It also means that if we withdraw $1 and put it under our mattress, we then reduce the amount of money by $10. That's how the amount of money can change in the economy. Next, we will talk about the Federal Reserve System as we prepare to talk about monetary policy.